Helen of Troy is a small company, about a $5 billion market cap, but has a small amount of analyst coverage. On Friday morning, the company reported adjusted non-GAAP earnings of $3.48 per share. By the way, this chart is from Robinhood, and it's comparing apples to oranges. The $2.62 is a GAAP figure, while the $3.48 figure is non-GAAP. The company's GAAP results were $2.94 per share. I'll go into this shortly. Still, the company beat estimates by around 14%, and you can see this chart goes back decades to 1981, and you can see the consistent growth and returns. There was this 3-year period of stagnation which resulted in a major restructuring effort that continues today. If you look at the company's quarterly income statement, you see that net income was actually down slightly to $2.31 a share. On the cash flow statement, you see that operating cash flow was actually negative $63 million because of working capital provisions. They still managed to buy back $110 million in stock. You can see that $221 million line of credit that adds up to the cash shortfall, plus the $52 million repayment you see there under it, plus the $110 million share buyback. The quarterly filing does provide a reconciliation of GAAP and non-GAAP earnings. The difference between the analyst's estimate and the company's adjusted earnings per share is that the company adds back that 53-cent non-cash share-based compensation. This expense reflects the fair value of options based on internal valuations or those of audit and consulting firms, but it's a non-cash expense because issuing warrants or shares doesn't cost anything. Before 2006, this expense wasn't required, only a note to the financials. The other cost adjusted out of GAAP earnings was that 52 cents a share in EPA compliance costs. The charges were assessed in connection with some of the claims made on some of the company's packaging and had nothing to do with any of their products' quality or safety. Beyond these issues, though, the company is a very strong performer and has a very valuable portfolio of brand names. These images are from the company's most recent presentation to investors, and you can see the strength of their results and their expected continued growth basically across the board. So that basically covers it. I wanted to cover this company because it flies under the radar even though it's such a great performer, and I've covered them in the past, and I wanted to cover those GAAP and non-GAAP issues. Thanks for watching, and please remember to like the video and subscribe to the channel. Thank you.